Alrighty. So today's video we're going to be talking about the stochastic oscillator, right? So I've got a number of requests to cover this stochastic oscillator. So this video I'm going to share with you how I use it to enter into my option trades and also my settings as well. So first off, what is the stochastic oscillator? So without getting to all the complex calculation, right, I'm just going to give you the layman terms of what the stochastic oscillator is. It's basically a momentum indicator used to identify overbought and oversold conditions in the market, right? So when the line goes above the 80 mark, it's considered overbought, and when the line goes below the 20 mark, it is considered oversold. So if you were to see your stochastic oscillator, you'll see that there are these two lines, right? These two lines should always be at 80 and 20. So anything that is above the 80 mark, this would be considered overbought, all right? And anything that is below the 20 line, right, this will be all considered oversold. Now, you notice that there are also two lines down here as well. So normally the way that they use it, or the way that is suggested to use it, is that when the faster line, in this case is the purple line or the pink line, crosses below the blue line, it means there's some kind of indication to sell, and if it goes above, it means an indication to buy, right? Now, when the reading is overbought, it means that there's a likelihood that the market will go down. So in this case, there's a likelihood or a chance or higher probability that the market will go down. And on the other hand, if the reading is oversold, it means that there's a likelihood that the market will go up. So this is what you call the overbought and oversold condition, the readings in the market. Now, one thing to understand is that this is not 100% accurate. It means that it doesn't mean that every time that the market is overbought, the market will definitely start to turn and go down, right? And it doesn't mean that if the market is oversold, that the market will always go back up, right? This is just a probability game. It's just a numbers game. There's always a chance that if it's overbought, it will continue to be overbought, and the market can keep just going higher, or if it's oversold, the market can just keep going lower. So just understand this, okay? Next, this is my settings. Now, the default setting of the stochastic oscillator on most platforms is 1433, right? I like to use 1033. I've been using it for the longest time, and I just find that this is better for me. You know, there's not too much difference. It's just that this gives a faster reading, right? You can use the default one if you want to, right? So it doesn't really matter that much. Now, the difference between most people, the way that they use the stochastic and the way I use it, is that I remove the percentage K, right? So there's a percentage K and the percentage D. Remember previously I talked about these two lines. Now, percentage K is the faster line, right? You can see that it moves squiggle much faster than the blue line, right? So for my purpose, I actually do not use the percentage K. I actually remove it. So I only keep the percentage D line, and the reason is because I use it to identify divergences, right? So I'll share with you a little bit about divergence later on, but for now you just need to understand that for me to identify divergence more clearly, I do not use the percentage K line. So if a good way for you to remember this is that, you know, D stands for Davis. You only want to use D because it stands for my name, all right? So in the TradingView platform, you can see this is just the settings I do, right? You can just unclick this box so that the percentage K doesn't show, and everything else you can just leave as default. And the 10 settings down here is under the percentage K length. All right, so let's get into the entries and exits. Now, because the stock market tends to go up over the long term, right, I only use the stochastic oscillator to find bullish entries, right? The way I enter into the market is much more medium to long term, where I can keep the trade on for months, even sometimes years, depending on how bullish I am on the certain stock or the ETF. But generally, I just keep it long term. I do not really re-enter into the market unless I see that there's a need to, right? So the entry tactics, there are three of them. So the first off is I will look for oversold near a support level. Entry tactic number 2 is to find bullish divergence, and entry tactic number 3 is to find hidden bullish divergence, and I'll go more into it later on. So what are the option entry strategies that you can use? Now, there are a number which I use, right? You can use the call lips. So this is when I have a very long-term view, and I really love to use this on index ETFs like the QQQs, IWMs. right? Because most of the time the extrinsic value is not as high as compared to individual stocks, and you have really far out expiration dates, right? So I like to use it using a college or index ETFs. Next is to use a cash secured put as well. Cash secured put is to enter into stocks. I have a video all about it in my channel. You can go ahead and take a look at it. Next will be bull call spread. This is when I'm a little bit more speculative for the short term, where I want to hold it for, you know, anywhere from 30 to 60 days. And then you have the poor man's cover call. So the poor man's cover call is basically just the long call option. All right, in this case I will use the long call leaps and sell a short call against it, which is covered call. All right, now the next thing is for exits. I tend to keep things simple, and I only look to exit my position when the market is oversold, right? So I only look for oversold. I do not try to look for the opposite of all this divergence, right? I just keep things very simple, because in the long term, the market wants to keep going up, right? So I always have a much more bullish view than I have instead of being bearish, right? Alright, so bullish entry tactic number one, look for oversold conditions near a support area or a previous low. Right, so what I'm really looking for is for the stochastics to have this oversold reading, and that this price movement needs to find a support. Right, so I want to find this support down here, a previous low, that it breaks it, and then I have an oversold area. Alright, so let's take a look at some trade examples. Alright, so this is of the IWM, right? This is on the daily chart. Now, most of the time, I only use the stochastics on the daily chart, because I find that it's slightly more accurate than if you were to do it on intraday. So I do not really trade intraday at all. So it's mostly just daily trades. Alright, so you can see there are two oversold readings down here. Alright, but the one we are going for would be this, and the reason is because of the support area, right? So we don't want an oversold reading just on its own. We want an oversold reading that ties in with a support area of a previous low. So you can see this is a previous low, right? Once it breaks the low, you can see it's oversold. So at this point in time, you can enter the different option trades that you want, right? You can enter into a call leap, a long call leap option down here, or you can sell a cash secured put somewhere below. Let's say if the price is at around 164, you see that there's an oversold reading, you could sell maybe the 20 deltas, right, or go somewhere around 150 based on where you feel you would like to own 100 shares of, right? Or if you're a little bit more speculative, you can enter a bull call spread, right? You can buy a long call, and then you can sell a call option down here, right? There's a bull call spread, or a poor man's cover call as well. All right, so there are a lot of different ways you can enter into the market, right? Now next, Visa. So can you identify where are the places where you could enter into a bullish trade? So there are a few. You can see that down here as well, it broke the previous low, right? This broke the previous low down here. We draw a support area. The market broke down, and then it's oversold. You notice there's another oversold down here. It coincides with this, but there's no real support area, no previous low down here. So we don't want to enter into this, because this will be considered one of those false reading, right? If you enter into it, the market is going to just drop, right? Same thing down here. You can see there's another oversold. This oversold, it went up momentarily before it dropped down again, but there's no real previous low that it broke. There's no support area. So we always want to couple this with a support to give us a higher probability of the market going back up later on. All right, so from down here you can see that this is the previous low, right? You draw a line across, an area across, so that you know where the support is, and you can see that in both instances, whenever there is an oversold reading, the market subsequently bounced up, right? Alright, let's get into one more example. So this is in sort of a sideways moving trend, right? The market is just moving sideways in the channel. So can you identify where would be possible areas where you can enter into a trade? Alright, down here, you see this is the support previous low. Alright, it broke the previous low, and then oversold reading. Alright, market went up. Alright, this time it took quite a while before it finally moved up. Down here as well. Okay, so it bounced off the previous low area. All right, previous low, it came up with an oversold reading, and then the market subsequently kept up on very good earnings. All right, so that is for the oversold. Now, bullish entry tactic number 2 is bullish divergence. All right, so this is where you want to ingrain your mind with this pattern that I'm showing you right here. So bullish divergence usually is a reversal, right? So it's a pattern, right, where the market is forming lower lows or a double bottom, but the stochastic oscillator is showing a higher low. So you can see down here, this is the waves of the pattern of the market. All right, you can see that it's forming lower lows, but then the stochastic oscillator is forming higher lows. So what you call this is a divergence. So this is a bullish divergence, indicating that there's a higher likelihood that the market will go up than it going down. So this is the bullish divergence when the market is in an uptrend. All right, this rarely happens. I've only seen it only a number of times, especially on a daily chart. This happens more frequently, right? But it does happen as well on the when the market is in an uptrend. So when the market is in an uptrend, you will see that sometimes it also forms this intermediate lower low, right? You can see that there's a lower low here, and then the stochastic indicator, right, is showing a higher low. So in this case, this is also a bullish divergence. All right, so let's take a look at some example. All right, so the first example, QQQs. All right, can you find places where there is a bullish divergence? Okay, so the first one is this. As you can see, the market is forming kind of like a double bottom, right? Right. So it couldn't break the previous low down here, but you can see that the stochastics, right, is forming a higher low. So this is a bullish divergence. So it went up subsequently above here. So depending on what is the option trade that you have, right? So maybe you have a cash secured put down here. So if you sell a cash secured put, right, once the market goes to an oversold reading, you could take off the trade, right? Or you could buy maybe the bull call spread, right? You could maybe buy a long call here, sell another call down here, right? Long call and short call, you get a vertical spread. Once it's oversold, you can take the whole position off as well. So as you can see, there's really a number of ways that you can enter into the market. So this is the second bullish divergence, right? You can see the market is making lower lows, right? It broke the previous low down here, and then there is a divergence, right? You can see that the stochastic is forming higher lows instead, right? Then the market, although it went down, right, went up, went down, it subsequently went all the way back up again. So sometimes it can be delayed. Right, now this is the third example, or rather the second example. So let's take a look at what this is. So can you identify the bullish divergence here? All right, if you spotted this, well, then good job, because you can see that the market tried to form a lower low as well. All right, went up, went down. All right, and then you can see that the stochastic oscillator forming a higher low. All right, down here, can you identify where the bullish divergence is? This is when the market is in an uptrend. So this is Amazon. All right, if you identify this, again, well done. So you can see that the market is forming lower lows, but then the stochastic oscillator is forming higher lows. So this, as you can see, is the bullish divergence, and the market goes up. And one thing that's good is that if it's in an uptrend, if it can bounce off a moving average, there will be even more better in terms of confirmation, because there are times where the moving average will be just nice cradling the price, right? So the moving average can also serve as a dynamic support, right? Dynamic support, dynamic resistance. So if the price was to bounce off the moving average, and then you get your bullish divergence at the same time, then it will be a very nice confirmation that the market has a strong likelihood of it going up than it going back down. All right, bullish entry tactic number 3 is hidden bullish divergence. So hidden bullish divergence is the opposite of the regular divergence, which I showed you earlier. So this is when the market, right, is forming higher lows, but then the stochastic oscillator is forming lower lows. Now, normally when the market is forming higher lows, the stochastic should also form higher lows, right? So let me show you an example down here. You can see that as it goes up, you can see that it's actually forming higher lows. All these are all forming higher lows. So this is how it should be, right? But when there is a hidden bullish divergence, you'll notice that the stochastic oscillator is actually forming lower lows. So this actually can provide a pretty good opportunity to enter into a long trade. Right, so this is in an uptrend, and in a downtrend, similar, right? You will see that the market, right, will be forming these higher lows, but then the stochastic oscillator will be forming these lower lows. All right, let's take a look at some trade examples. Right, so can you identify where the hidden divergence is on this chart for Starbucks? All right, so it's over here. You can see that the market is forming higher lows. Right, the market is generally going up, but then there is a very obvious lower low in the stochastics. So as you can see, the moment at this point of time, it also coincides with the market being oversold. Right, sometimes it does, sometimes it doesn't, but that's not important. Right, what's important is that it actually forms this lower low, these two valleys down here that is lower than this two. All right, so you can see that after this happens, the market goes up. All right, let's take a look at another example. Right, so can you identify the hidden bullish divergence here? All right, just pause the video if you have to. All right, so it's here. So the market is going up, right? Again, forming higher lows, but then the stochastic is forming lower lows. And soon after, although the market just bounced up and down for a while, eventually went back up. All right. Another example, this is the last example, this is on Apple. You can see the market is in an upward trend. Can you find where the hidden bullish divergence is? Alright, so as you can see, the market is generally going upwards, right, forming these higher lows, alright, down here and down here as well, compared to this. And you can see that the stochastics is actually forming lower lows, right? So you have higher lows and lower lows, and the market subsequently went higher. Alright, so what about exit tactics, right? So basically, exit tactic, as mentioned, I like to keep things simple and only take action when the market is overbought. Alright, so if I'm in a profit and the market is overbought, there are three options that I'll do. First is I would sell the cover call if I don't have a cover call, right? I may have 100 shares or I have a long call, right? So this is time where I'll enter into a cover call position, right? If I already have a cover call, if the cover call is in the money, then I can consider rolling the cover call, right? I'll roll it out and up. And if I decide that, you know, it's time for me to close the position, if I cannot roll the cover call anymore, if I already have one, right, then I'll just simply close out the whole position. So it's pretty simple when it comes to exiting, right? But if I'm in a loss, then most of the time, because the rationale of me entering into the trade in the first place is generally a long-term view, I generally tend to just hold on to it, right? So a lot of this, I tend to use it as a investment, options investment. So if I have a call lip, I tend to just hold on to it, especially right now when the market is dropping. I just hold on to the lips, right? If it goes closer to my expiration date, I can choose to roll it. And if I have a cover call, again, do nothing, or I can just be aggressive and roll the cover call down. If I have a cash secured put, I just let it assign if it's in the money, right? I can just let it expire in the money. I get the long shares, and I get the long shares. The market goes back up again, becomes overbought, and I can sell a cover call. I'll sell a cover call then. But if for a bull call spread, because the bull call spread is basically a speculative trade more in the short term, so I'll basically just close it out once I reach 50% of the max loss, right? So if I risk $1,000 on the trade, once it reaches around $500 loss, I'll just close out the position. Alright, let's have some takeaways. So the stochastic oscillator is a great tool to identify overbought and oversold conditions. Right, it is not 100% accurate. This is very important to understand. Right, a lot of people will put all their money into that one trade whenever there is a very extreme oversold condition. Right, this is not what you want to do. You still want to have proper money management and just put a certain percentage of your account on each trade. Alright, so in case if you are wrong, you still can survive for the next trade again. So what the stochastic oscillator does is that it gives an indication that the market has a higher probability of turning when the market is overbought or is oversold. Now next, the stochastic oscillator can also be used to identify divergence, right? There are two types of divergence. You have the regular bullish divergence, that is when the market is forming lower low wave patterns, but the stochastic is showing a higher low wave pattern. Then you have the hidden bullish divergence where the market is forming higher low wave patterns, but the stochastic is showing a lower low wave pattern. And there are a few option strategies that you can use when there is a bullish signal, right? You have the call lips when you have a very long-term bullish view. You can use the cash secured put for prices or areas where you want to get long 100 shares, when you get long 100 shares of the underlying stock, and then you can get into a bull call spread for a more speculative short-term trade anywhere from 30 to 60 days, and then you have the poor man's covered call as well. And if the position is in profit and the market is overbought, basically you sell the cover call, right? You can choose to sell the cover call, you can choose to roll the cover call, or you can just choose to close the position as a whole. Alright guys, so I hope you liked this video and you found this video useful. If you have, kindly please subscribe and also give me a thumbs up. And as always, thank you for watching. I appreciate your time, and may the options favor you.